For this video, we're going to take a quick look at the statement of cash flows. Now, as you can see from the screen already, statement of cash flows can be very confusing. We'll look at a much simpler example and one that we can apply to the project that we are working on at this point. One thing about the statement of cash flows is you are looking at what caused cash to increase or decrease. To do this, we will look at cash transactions. We will group them by similar functions. There are three main functions: operating, investing, and financing. Those that involve the normal operations of the business go in the operating section. Those that involve long-term assets are involved in the investing section. And then the financing generally deals with long-term liabilities and our equity. So if we take a look at our example down here, let me switch over to Excel. I'm going to go ahead and bring up both pages. So I've got my statement of cash flows over here. Basically, all I need to know is what happened with cash. So I can look over here on the ledger over here on the left hand side, and you can see here's my cash account and here's some transactions that impacted cash. So I need to figure out, well, why did I receive this cash, or why did I pay this cash out? First of all, you can see I've got a $10,000 debit. I'm going to go ahead and do the inflows first and then the outflows. In the end, I need to prove how I got this $8,722.08. So I've got $10,000 and saying it's coming from journal page 1 D6. So let's go to journal page 1 D6, and here's all my transactions. You can see journal page 1 D6. Now cash is coming in due to common stock. That would be an investment from the company. So I'll go over to my net flows, cash flows from financing, and I can say cash invested by owners. And here I'll go ahead and link, and let's go ahead and link actually to the ledger. That's a little cleaner. That can show that I'm definitely linking everything from the ledger. So I'll go ahead and link to the ledger, the $10,000 debit, and I've got a positive $10,000. I've also got $125 coming in here. So let's go back to that journal page, and we can see that's coming from this line right here, and we can see that's coming in due to fees earned. So that's the normal operation of the business. That's receiving cash from customers. So I'll go up to cash flows from operations, cash received from customers, and again I'll link, and over here let's go to our ledger again and pop that in. Now I've got to go look at that ledger, and I see I've got 3 credits. So I've got this $500. Let's see why I paid out the $500. I go to the $500. I bought office supplies. It's a normal expense for the business, so let's just say cash paid for expenses. And while it's technically not an expense right now due to it being a supply, supplies, once they're used, become an expense. I'm okay with you grouping those together right now. So any bills, any expenses, cash flows from operations. Now one thing about this is we got to remember this is a negative amount. This is a negative on the cash flow. All I'm worried about on the statement of cash flows is what is happening to cash. Is it going up or is it going down? I've got a $600 credit. Why is this $600 being credited? Well, let's take a look. We can see over here I paid for a portion of a car. I didn't pay for the entire thing. I've got a notes payable for $1,400, but I did pay for $600 of the car. So I'll go ahead and go back. Since I'm dealing with a long-term asset, that's going to be cash flows from investing, and this is again cash paid for car. So I'm going to negative that number. Cash is going down. And there we go. It's very common for your cash flows from investing to be negative, especially at the beginning of a company. Lastly, I've got a credit for cash for $302.92. So why am I paying that? Well, we can look down here. It's at the bottom, cash credited $302.92. And we can see it's actually a payment on this notes payable, and it includes interest. Now, some would say you move the interest up to cash flows from operations. I'm okay with this being included together. Since this is a long-term liability, I would include this in financing. So let's go to the general ledger again, and we'll go ahead and call it over here cash paid on notes paid. That's a financing activity. It's how we received some funds for our company. So again, negative, and grab the $302.92, and we can see due to rounding it's going to say 303 on here. Now if you look back at the journal page, just one thing I want to point out, you can see we've got a sale on account on here on the 4th. Cash isn't involved, so it does not show up at all on the statement of cash flows. If that customer were to pay later on, we could include it in cash received from customers. but since he has not yet, we don't include it yet. To finish up our statement of cash flows, we simply total up our different activities. So equal sign, just for the sake of practice, we'll do sum. We can see we've lost $375 due to our operations. Again, equal sign, practice, the sum. We've lost $600 due to investing, equals sum. But we have gained $9,697 throughout our financing. To figure out our net change, we simply add up the cash flows from each activity, and we can see there's our $872. We began with no balance. We had a net change, a positive change of $8,722. Our ending cash balance, add the two up, will be $8,722, just as it says on our ledger. Now, example is easy for us. Here's Apple from a few years ago. They had to go from $5 billion at the beginning of the period to $11 billion at the end. So how did they get $6 billion? You can see most of it came from their operating activities. They lost some in investing activities because they were investing in actually other companies. That's marketable securities. And they gained some from financing because people bought their stock. So that's where the detail comes in. It is much more challenging at that level. But at our level, I think we will definitely be able to accomplish what we need to accomplish.